Hello and welcome to Lessons Learned from Mortgage Financing Roundtables. My name is Brandy and I will be in the background answering any WebEx technical questions. If you experience technical difficulties joining the WebEx session, please dial 1-866-229-3239. For today's event, we will be holding a live Q&A session. In addition, you may ask an online question anytime throughout the presentation today by simply clicking on the question mark icon located on the floating toolbar at the top of your screen. We will address as many questions as time permits at the conclusion of the presentation. With that, we invite you to sit back, relax, and enjoy today's presentation. I would like to now introduce your presenter for today, Craig Nickerson. Craig, you now have the floor.
Accessing mortgage financing, and we're going to share with you the lessons learned from some mortgage financing roundtables that HUD sponsored this past summer. I'm going to share those lessons learned today with you. My co-presenter today is Rob Grossinger, who many of you know with the Enterprise Community Partners, heads up their neighborhood stabilization, their community stabilization activities there. This is Craig Nickerson, and I'm president of the National Community Stabilization Trust. We'll also be joined today by two other observers, panelists, participants, whatever you want to call them, who were active participants in those roundtables last summer. Kim Stans with the City of Columbus Department of Development, and Matt Callahan, who wears a number of hats based in California, but has a mortgage operation focused on first-time homeownership and neighborhood stabilization activities as well. Both participated in the roundtables. So thank you for being patient with us. We're starting a little late here. And hopefully you have the deck in front of you. I'm going to jump right into it. So we sort of covered the who's who. And here's just a heads up here that this is the first of 3 webinars in a series focused on financing. This first one is going to share those lessons learned from the roundtable and some of the basics of the mortgage lending industry in 2012. It certainly is different than it had been just 3 or 4 years ago. And then next week, next Tuesday, January 24th, we'll have a follow-up discussion, which is a deeper dive on some financing tips. We'll get into more detail on such things as, the differences and benefits of FHA versus conventional financing. What about private mortgage insurance? What are some of the techniques that people are using in seconds that seem to get the biggest bang for the buck, that kind of thing. And then the third of the 3 seminars will focus on interim financing. And by interim, we're really referring to any short-term financing that you may be seeking to leverage your NSP dollars to make them go further for the acquisition and renovation, typically, of some of these properties that you're picking up, some of the foreclosed and abandoned properties. There's also 2 backup resources that you should look to obtain here in the very near future. I don't think they're available quite yet, but I think you'll find them very, very useful. They're in final draft form. One is called the Guide to Understanding Mortgage Financing for NSP-assisted homebuyers. It is a good resource for how things work today, and what's the formula that might engender the greatest likelihood of success in helping your families acquire that mortgage financing. And then the corollary document is a somewhat more concise interim financing for NSP guide that also is in final draft form. I would expect both will be available within the next 30 days. All right. So what are we going to try to do today? Rob and I are going to try to separate some fact from fiction for you. Within the mortgage lending industry, there's a lot of misinformation out there, and we want to make sure that you've got the real facts, not some of the myths that are permeating. Secondly, we want to identify ways that your local program design can be structured to maximize the effectiveness of securing mortgage capital. A subset of that is we'll talk about soft seconds, some of the mistakes we've seen, some of the questions that came up at the roundtables about the way to structure those, and some do's and don'ts. And then lastly, we will identify what we've heard through the roundtables as some of the key obstacles that grantees are facing. Now, these roundtables, and I'm sure many of you We have over 160 folks on the phone here. I'm sure many of you did attend one of the roundtables. There were 6 of them. They were presented by Enterprise Community Partners and the National Community Stabilization Trust, and they were sponsored by HUD. So HUD was our partner in all of these, attended all of them, and greatly facilitated the dialogue. You can see the locations there on the screen. I won't bother to read them to you, but each of those sessions comprised somewhere between 22 and 27 or 28 people. Usually we had one GSE representative, 1 or 2, and then 4 or 5 primary lenders, some of the big players like Bank of America, Wells, Chase, Citi, and then typically some smaller or regional players as well. We wanted to get that sort of array of perspectives. So in any one session, there might have been 5 or 6 lender representatives at the table, and then the majority of the participants were, in fact, NSP grantees and their subrecipients. Interesting to see how regional differences played out in some of those discussions. So HUD had asked that prior to those roundtables that we do an assessment of some of the grantees, the NSP grantees, to see where your stumbling blocks were, where you were having problems. And we're not going to go into that in great detail. It's somewhat dated information now. I think we did it in May and June of last year. But you can see here from the summary that by far the most significant takeaway was that over 75% of the respondents felt that they had real problems in accessing permanent mortgage financing. And frankly, if I remember correctly, only about 11% they had no problems with financing. So a real concern out there. A lot of folks who had done well at acquiring property, renovating property, only to find out that it was difficult to qualify borrowers. Credit worthiness was the primary obstacle identified by those respondents, both poor credit or impaired credit, as well as maybe no credit or non-traditional credit. Those were all sort of top findings in the survey. And when asked what kind of financing the grantees were typically using, the most prevalent answer, 76%, said FHA, 64% said conventional financing, and interesting, 23% said they were seeking either 203K or some other form of purchase rehab financing. So really looking for basic financing here, FHA or conventional, and still having a struggle. And probably the most telling takeaway leading into these roundtables was that many of the grantees felt that part of the problem was that lenders just didn't understand what they were trying to do. Didn't understand the NSP program, didn't understand neighborhood stabilization as a concept, and perhaps were having trouble relating to some new terminology when, they finally, in many cases, got accustomed to maybe home program or CDBG terminology. So there were 5 key takeaways from those roundtables. Let me summarize those briefly. First, securing permanent mortgage financing for these prospective home buyers was a daunting challenge, as I said, for 3/4 of all of those that were participating in the roundtable, same as the assessment, and that credit was a huge issue. There's no question out there that, and we heard this from Fannie Mae and Freddie Mac, from the lenders as well as the grantees. There's no question that there has been a overcorrection here. The pendulum has swung too far in the opposite direction in terms of conservative underwriting, tight credit, higher credit scores necessary, and that we're living in that environment now. Will it get better? Absolutely. Everybody felt so. But it's almost inevitable when you go through this kind of a cathartic housing crisis that there's going to be a correction, particularly when your GSEs have changed their status, I guess is the nicest way I could say it. Thirdly, we found that the subordinate financing, the soft seconds that many communities were structuring, didn't fit lender rules. And I really think a lot of that was just lost in translation. You might have been using a soft second structure that's similar to what you had used in previous programs like home or CDBG, but lenders went through a whole new regime of reviewing them and identifying them and sending them by different parts of their corporate structure, and in a conservative environment, they might have gotten a much closer review than had been the case in the past. Two last takeaways from the roundtable, and this was, in every session, this was one of the key takeaways. It kind of surprised me a little bit. Low or inappropriate, inaccurate appraisals was a constant theme. We've got a real issue here. I know we've talked to our friends in HUD and NSP about this issue, and we're looking at different ways of trying to resolve that issue in terms of practice or education. But a big issue that's across the board, whether we were talking in Chicago, Florida, or California. And then lastly, this misinformation it certainly applies to the appraiser, but it applies to realtors and other real estate professionals, and it applies to lenders. A lot of just need for better education so that everybody understands what we're talking about here. I suspect that many lenders see this as lending in distressed markets as opposed to lending in concentrated stabilization markets where a whole bunch of things are happening to right-size property values and to create a good lending environment, frankly, where properties are fully renovated, where prospective buyers need to go through homebuyer education, where a lot of money is being invested to fix up properties in a concentrated way. We just need to tell that story more effectively. So a couple more slides, and then I'm going to stop and see if there's any questions, and then turn it over to Rob. So I mentioned this before, but on the slide you see before you now, the lending landscape today, there's no question that what we're seeing is a different landscape from, say, back in 2005, 6, or even early 2007. Bank of America, Wells, and Chase, just to name three institutions, have been originating more than half of all mortgages in the last couple of years. That is beginning to change. We are seeing a resurgence of regional lenders and community bankers and smaller mortgage originators, mortgage bankers, grow in status here. But there is a high concentration of activity in some of the big players. And, of course, we don't have the broker network, the mortgage broker network that we had back in 2005. So that's changed the landscape. But the landscape also is, in a way, a return to some of the basics. We see a resurgence of FHA. FHA at one point, back about 4 years ago, was down to about a 4% market share. They're now somewhere, I think, close to 30% of all mortgage originations, and clearly more than 50 or 60% of all first-time homebuyer originations, and certainly that would be the case in NSP markets as well. With respect to the GSEs, Fannie and Freddie, we are seeing a renewed reliance on them and the sort of liquidity, stability, affordability roles they play in the marketplace. But frankly, with more conservative sort of application of their array of mortgage products than might have been the case a few years ago. But they're still in the game and very active. I'm going to ask Matt Callahan in a minute here to speak to that issue. But let me just finish the last 2 points on this slide. There is a return to fundamentals. There's no question that we're returning to the 3 C's of credit, capacity, and collateral. And something interesting that we're going to spend a lot more time talking about next Tuesday in the second webinar in this series, but there is a reemergence of portfolio products. Some of them very specifically designed to address neighborhood stabilization activity. And we think that bodes well not only as a product, but as a sort of incentive for the broader industry to increase their flexibility. As we move to the next slide here on the return to the 3 C's here, you all know about the 3 C's and what's happening here. But, Matt, I might ask you, since you are actually helping homeowners to obtain mortgages and having to deal with these 3 issues of credit, capacity, and collateral, what you're seeing on the ground there in terms of credit score, are we talking for the GSEs, for example, only focusing on credit scores in the 700s now? And what about FHA?
would say that in Southern California, where we operate and support various NSP programs and other first-time buyer programs, that credit score targets are generally 620 or better, and that's both on conventional and FHA loans. Really, there's no mortgage financing at reasonable rates and terms below 620. But I would say that it's not accurate to say that on a conventional loan that you have to be in the 700 range. Both Fannie Mae, My Community Mortgage, and Freddie Mac's Home Possible loan will permit scores down to 620. And frankly, when you're using subordinate financing through the NSP program and your loan to value is at 80% or below, that's going to be typically the most cost-effective choice for the buyer.
Great. Good. Very, very helpful. And then, Matt, before we turn it over to Rob here, just on the collateral side here, the loan-to-value has been an issue for a lot of folks, particularly when you're adding the subordinate financing, and we'll talk more about that. But are you seeing sufficient flexibility on the LTV and the TLTV, the total loan-to-value, with the GSEs and conventional lending as well as FHA?
Yeah, that frankly has not been a problem for us. Both FHA and Fannie Mae's My Community Mortgage products will allow total combined loan to values over 100%, typically to 103, 105%. So that allows us to incorporate the subordinate financing, the NSP subordinate financing, with the first mortgage and any other down payment assistance that might be available, and cover not only the acquisition price for the buyer, but closing costs in many cases as well.
Great. Rob, I think this is a good point to hand off to you, but should we, I'll ask our organizers here whether we should stop for questions now or keep moving ahead until the end. Well, Rob, I'm assuming that means it's yours.
Okay. Thanks, Craig. The next 6 or 7 slides that I'm going to go over really are a description of what program designs could have been or still could be if you're newly funded and still thrashing through program design. Again, this particular webinar today is based on what we did in the regional ones. For some of you that attended the regional ones, there's going to be a lot of repetition. And for some of you that are 3/4 of the way through your program, your response may be, yes, I've already done that, or I didn't do it, but it's too late to do it. But remember, there's always program income and potential other ways to approach this in the future. So some of them are just thoughts for the future. But again, a lot of you are farther down the road than the next 6 or 7 slides were designed for. It's really for thoughts in the beginning, but it's never too late to make either corrections or change course or do whatever. So obviously what we found throughout the country in the first couple phases of NSP were 2 different ways to go about this. One is the direct-to-home buyer financing, where you basically put out information about the program that you can get down payment assistance if you can come in pre-qualified for a house, and then all of the compliance issues and all of the qualification processes go on from there. But what you usually get is a prospective home buyer who is already pre-qualified up to some amount to buy a home, and you're adding the down payment assistance to take them over the top or to make it more appealing for them to buy a previously vacant property in maybe a neighborhood that is hoping to stabilize or improve. The issue is, and what we have yet to learn as much as we would really like to learn about, is we don't know about all of those prospective home buyers who've gone to their bank to get pre-qualified and then are denied, or told you're qualified to borrow $30,000 when in fact they need $150,000 for the cheapest house in the neighborhood. In that situation, you never see them because they don't come in for the down payment assistance. Some may have people coming in going, I can't get qualified, what can you do for me? But for a large part, the direct-to-home buyer model relies on other people going out, the prospective home buyer going out and getting that pre-qualification and then going forward. The general theme of this is, so why is mortgage financing important? Well, if you can't get any qualified home buyers, even in the direct-to-home buyer model, you can't spend your money. The second model, which is the turnkey, it becomes much more problematic because you or one of your subcontractors or designees have gone out and purchased an REO property, rehabbed it, and now you want to sell it, and there's nobody qualified to buy it. And so there's the liability comes very much into play because you're sitting on an asset that is going to start draining you from a maintenance standpoint, and you have no way to sell the property, and you have no way to repay, if you have to repay the NSP funds to the initial grantee, and you have no way to recoup any costs you've put into that house. So there's a number of reasons which is sort of a duh to all of you. You all know that mortgage financing is really important and why it's important, but we have very different responses from around the country about why it isn't as free-flowing as it should be. So I'm going to, for this next few slides, I'm just going to go over some of these two different approaches and some of its pieces. I think we're going to then move into some other deeper, no, go back, Tasha, to direct-to-home buyer approach. There we go. Then we'll go in more detail, and then next Tuesday we'll become much more detail-oriented in terms of what are options with all of this in terms of mortgage financing. But obviously the direct-to-home buyer approach is the home buyer's going out there and picking their property. You're verifying that it's within your NSP target area and whatever other conditions you've put on it. And they then hopefully close pretty quickly with your down payment assistance or whatever other assistance you're giving them. In some cases, if there's more rehab than necessary, then really desirable from the home buyer using their cash, you might want to look at the FHA 203K. We have had a number of grantees begin conversations with the financial institutions that offer 203Ks. Some have been very successful at bringing that into their program, and then the lenders are out there making 203K loans to home buyers who are then doing the rehab paid for on top of the acquisition price. At the bottom of the slide, it says alternatively subordinate public-private capital is available for property renovation. That becomes more difficult for an individual homeowner. That tends to exist more in the developer and the turnkey approach, but occasionally you'll have a public sector entity that makes rehab loans directly to homeowners, and that can be layered on top of the mortgage financing, obviously in a subordinate position. So that's all. I think for most of you on the phone, that's all pretty self-evident. So then, again, it all comes back to, where's, as the old commercial used to say, where's the beef? Where's the mortgage financing? On the turnkey side, it becomes much more difficult for a developer to finance the acquisition and purchase unless it's totally done with NSP dollars. It's more difficult to find those mortgages out there for a developer to do this than it is the 203K, for example, for the homeowner. It's much more difficult in the turnkey. There are times when, and hopefully you don't get into this position where you've bought the house and then realize renovation is way too extensive for you to do, because then you're stuck with something that is going to be very difficult to fix up and sell and may even be in need of demolition. You really want to be able to execute quickly in terms of having it all move through the process. You want to time your acquisition rehab and then have qualified buyers right behind. Again, I know I'm speaking to the choir. You all know this. The problem is it just hasn't happened, and there's lots and lots and lots of NSP rehab properties sitting out there because of some more factors we're going to go into in a little bit. But the basic change in underwriting and the hesitancy that mortgage lenders have into entering distressed areas. So, program design. And later in this presentation, I'm going to bring in Kim Stans from Columbus to talk about what he did to bring the players together to talk about how do we make this work better in our area, as opposed to just looking at everyone and pointing fingers at who may be the problem. If you can identify the financing that currently is available in your market before you design your program, that's a really good thing. However, again, I think all of you are too far down the road. I may be extrapolating from individual conversations, but I think a lot of you are too far down the road to go back and redesign your program based on the type of financing, and what you found is there was less financing available than what you were hoping, or it was more restrictive than what you were hoping. Lenders obviously are uncomfortable with risk. That's why they're lenders. They're less comfortable with risk when there's repairs needed, and depending on whoever has to do the repairs, they become even more uncomfortable because then they have to be sure that those repairs are done in a way that the asset itself, which is the collateral, stands behind the loan in sufficient value. So what is the level that you're going to get involved in? What's the level that the homeowner is going to be involved in? What types of properties are you targeting in terms of purchase and rehab? That all comes into play. And again, this may be for the future. As you start to recycle program income, you can really hone your skills in terms of designing how you're going to spend your money and what you're going to spend it on based on the frustrations you've had in the first place. Go to homebuyer assistance options. The biggest thing we found from the regional discussions were that many of the homebuyer assistance programs that were created without sitting down with your lenders and making sure that it qualifies under the secondary market qualifications. We're going to talk about that more in a little bit. And more importantly, are you really adding to the value of getting a loan done? Have you sized your homebuyer assistance? Have you put as few restrictions as possible so that it matches up with first lien mortgage lending? Are you choosing to cover the real barrier, even though money is fungible? Are you covering the real barrier that homeowners have to be able to buy that loan? Are you doing something in the way of creating a barrier between an impaired credit borrower and a lender who wants to see somebody with pure credit? Meaning, are you doing something along the lines of a guarantee or a loan loss reserve, which will give them comfort for stretching a little bit? Or are you simply bringing down the total cost of the transaction to make it more affordable to potential home buyers? Those are all decisions that should be constantly reviewed because, again, the more information you can get from those homeowners who don't come to you, obviously that's like punching a cloud in the sense that you're trying to get information from people who have not come into you necessarily, but to find out who's out there trying to take advantage of your program and having trouble doing it and finding out why helps you down the road tweak that program to make it more available to the basic population that you want to make it available to. And the last thing I just wanted to mention, last couple of things I wanted to mention before turning it back over to Craig, is that there's a number of different ways to do what you want to do, but the simpler you keep it, the better. What we heard from lenders, and those were, for those of you that did attend the regional roundtables, the lender participation, I think, in every one of them were very honest, straightforward, forthright. In fact, what you heard was a lot of the lenders saying, you know, my own institution is my own worst enemy. I have my hands tied behind my back a little bit, and so if you tie my legs while my hands are already tied, I can't get anywhere. So we really need to talk ahead of time as you're creating any of your opportunities and any of your products so that we can try and match that from the bank standard by which we have to operate. And we'll talk next Tuesday and also a little bit more today about how banks have some flexibility in this. I wouldn't say it's a lot, but some. And when I say banks, I mean all lenders. When you have borrowers who are credit challenged and you want to reach them, there's a number of different ways to try and help them. That's on your credit challenged options. I think that's the next one, Tasha. Thanks. I would ask you to think very carefully about all of these because they all have both their pros and their cons and unintended consequences. So saying that you're going to look for government loan guarantees means they actually exist out there in any sort of plentiful way or beyond FHA, and that may not be true. And loan guarantees that you thought once were obtainable may not necessarily be obtainable. Putting up a cash or cash equivalent reserves, unless you are really designing that carefully, you will lose those reserves, and that's not really something you want to do. co-borrowers, again, all of these because you're in this industry, have their pros and cons and sometimes produce unintended consequences to your program. The last one, lease to own, is one that requires probably 6 days of webinar conversation, because those of us who've been in this industry long enough know most people run away from it because it hasn't seemed to work in the past, and yet those that aren't running away from it keep saying it's the panacea into the future. The truth is somewhere in the middle in terms of how that could really work, and someday maybe we'll have a 6-day conversation about how to structure lease to own. So anyway, I'm going to turn it back to Craig. Again, this was not anything earth-shattering to you. All of you were running your programs. We're sort of setting the stage for both what we learned in the regional conversations, but also leading us into next Tuesday.
Okay. Let's get a little deeper into the soft second issues that Rob covered with you, and I couldn't agree more with Rob's point about simple is better. I think sometimes our own creativity and desire to be innovative in our structures has hurt us. It clearly slowed down the process with many of these lenders. But let's talk about where that problem exists, where the snags are, and how we can continue as we hopefully get more NSP money, or project rebuild happens, or something else, other federal flexible subsidies become available, that we can leverage the lessons learned to date. So soft second structures. Very important, I think, to have a brief discussion about recapture versus resale. And let me define the terms here, because they're both sort of generic terms. By recapture, we're referring to the more typical way that you structure your subsidies, where there's a lien on the property that would be repaid at some future date. Sometimes it's even forgiven, but it's a lien on the property. When the family in 10 years sells their home, they might have to repay some or all of that obligation, but there's no other covenants or restrictions on the property beyond, the distribution of any equity at sale. It is a market rate transaction. And I think 80% of the soft seconds we have seen out there fall into this category of recapture. Your deferred payment loan, no monthly payments, forgiven over 15 years. Your deferred payment loan due at sale or transfer. Those are typical recaptures. Resale, by resale we're referring to the notion of trying to ensure that we preserve that affordability. I think you all know that in the statute for NSP, there's language about preservation of affordability. In the most literal sense, that could mean, but doesn't have to mean, that could mean that you want to ensure that that property remains affordable beyond the actual ownership, the current ownership of that new home buyer. And the way you preserve that affordability is typically through some sort of covenant or deed restriction that runs with the property that would say, for example, if and when you choose to sell your property, you must only sell to someone at a certain income level, or you must only convey the property at a certain fixed price, not necessarily the market price. There are states, New Jersey comes to mind, where there are some statewide encouragement, if not requirements, to do a resale type option. And some markets that are high-cost markets, parts of California, for example, I would suggest, maybe some other parts of the country, where once we are successful in restabilizing these neighborhoods, we may see an escalation of property values, a gentrification. In those markets, this may make sense. But, lenders hate this stuff. They hate the resale recapture, the resale with the deed restriction approach. They will often give you the knee-jerk reaction, I can't do that, I won't do that. They can do it. It just takes a lot of brain damage for them. The GSEs allow it, but with a lot of brain damage. That's my term, not theirs. And I really shouldn't be editorializing on a webinar, a HUD-sponsored webinar, but if I were allowed to, I would probably question the appropriateness of most of these deed-restricted programs anyways, because after all, what we're trying to do is raise property values, not do something to limit demand for the property or limit future value of the property. So, sorry if it sounded like I was getting on a sermonette there, but I think that's a very important point for us to consider. So what about Fannie and Freddie? What about their requirements? So we heard in a number of the sessions from grantees that the problem was Fannie Mae or Freddie Mac, that their guidelines around soft seconds were so cumbersome and restrictive that it precluded getting their local lender to play. We think that's a myth. For the most part, the soft second structures that both of the GSEs have created are very flexible. And I would suggest that the vast majority of the soft seconds you've created, whether you knew about the GSE requirements or not, would meet the test. You see on this slide here some of the no-nos. You certainly don't want to charge an interest rate that's higher than the interest rate on the first mortgage. I don't think you would do that. But if you did, and certainly if it was more than 2 points higher, the GSEs would not buy that mortgage. That's not likely. Accrual of interest at all. Does that happen? I don't think 9 out of every 10 soft seconds I've seen do not accrue interest, and I think that's a good thing. It's particularly a good thing when it's a deferred loan, when there's no monthly payment required, but interest is silently accruing, sort of unbeknownst to the borrower because they've forgotten about it. They're not sending in a monthly payment stub. They're not seeing a balance growing. If you had a deferred payment loan, due at sale or transfer with a simple interest of 3%, that could be very dangerous because it basically is siphoning away any accrued equity that might occur and might surprise that borrower at time of sale. Well, the GSEs don't like that at all, and you'll find that they really refuse to purchase products that have that kind of a structure. Both Rob and I mentioned combined or total loan-to-value. This is the loan-to-value including the first mortgage we're seeking from a mortgager plus your soft second or third or fourth and any other indebtedness. There might be another rehab loan on there or second or third. The combined loan-to-value of the first and other subordinate financing generally cannot exceed 103 to 105%. So you might have a first at, let's say 85%. You've got a second, a significant one, to cover the gap between your costs and the value of the property of another, let's say $40,000. That would be $85,000 plus $40,000. What's that? That's $125,000. That wouldn't fly typically. So you've got to be mindful of that in terms of the total loan to value, not just your loan to value on the first mortgage. And then lastly, and there are many other factors here. Next week we'll talk about it in more detail. But the other key factor we wanted to bring to your attention now is you certainly want to make sure that your soft second doesn't have a hard edge to it, and that hard edge being that it's due and payable before the term of your first mortgage has expired. So,
Craig?
Yeah.
Hey, Craig, it's John last week. I don't want to make a big issue of this, but we've been discussing HUD's unwillingness to go over 100% for a variety of reasons, and so I just want to throw that out now without getting into the details. But I mean, I understand what you're saying here. I think our solution to these things would be that you would need to consider the last 3% or 5% or whatever over combined loan to value of 100% to be a grant rather than a loan. We're very reluctant to get people into negative value situations right out of the gate.
I think I'm glad you did chime in, John, and I think that's really encouraging news. I found that many NSP grantees don't realize they can do that anything in excess of 100% can be in the form of a grant, and that's definitely the easiest and best way to execute this structure.
Right. A lot of times it's just a matter of how you account for it, and granted, some of that you won't get back in program income, but most of these soft seconds you're not getting back anyway. But we've just gone around on a couple of scenarios like this, and I think we would just prefer that everybody keep it to 100%, and then just make up that difference with consider whatever that difference is to be a grant rather than something that possibly requires payment in the long run.
Good, great, good news. The last of the bullets here, Tashra, you just go back for a second. I just want to finish this last point on balloon payments. Please make sure you don't have you may have a deferred loan that's due and payable in 5 years or 10 years or 15 years or 20 years. Don't have it due and payable except at sale or transfer of the property or refinancing of the property in some instances, because you want to make sure that you're not GCs want to make sure that their first position is in fact protected. Now that's pretty much common sense, I think. So on the next page here, you do see the access point for, and I think some of you have asked the question, can we get this PowerPoint after the presentation? The answer is yes. But on these links, you'll find two very helpful explanations of Fannie Mae's community seconds and Freddie Mac's affordable seconds that would help guide your structures going forward. Let's move to the FHA, and we're going to be brief on this. We're going to talk about it more next week because there's some arcane aspects to it. But for the most part, and Matt Callahan, a heads up, I'd like you to speak to this in just a minute. To some extent, FHA sub-seconds are easier, and in some other respects, they can be harder. Harder in terms of who's providing the soft second and some of the hoops you need to go through to get approval. But generally speaking, common sense rules here. The same kind of provisions that the GSEs have adopted would be applicable to FHA. And again, as you see this last bullet, resale restrictions, again, this notion of doing something that's creating a deed restriction is strongly discouraged. And with both GSEs and FHA, if you are doing a resale structure, please make sure that you put a provision in there saying that in the event of foreclosure or a deed in lieu of foreclosure, that those deed restrictions would be waived. That's an important point. Matt, I would love your view here. I know in your work you've originated both FHA and conventional, and how do you see the soft seconds playing out?
Well, in terms of approval of a soft second program for use in FHA or conventional, the requirements are essentially the same, as you said, Craig. The one thing that I see different and a little more onerous with FHA is that approval of an FHA, approval by FHA for a soft second program requires a lot more information about the issuer of the soft second, the municipal entity or whatnot that's going to be providing it. You need to provide a lot of information like taxpayer ID and that kind of thing. And so it can take more time and effort in getting it approved. Once it is approved, I haven't experienced a substantial difference, and it's worked quite well. Both FHA and conventional loans are, work very, very well with the subordinate financing programs, and it really comes down to, in terms of selecting the product, what's going to be most affordable to the home buyer.
Great. And we'll talk a little bit about that in a minute, the FHA versus conventional. Thanks, Matt. Let's move on here, and you'll see on the next page here another link to get more information on it. And let's just go to some of the pointers here. And these are not absolutes. These are suggestions that we've put together for you, sort of to summarize some of the things that Rob and I have just covered. Deferred loans are definitely the cleanest form of subordinate financing. The fact that you're not expecting a monthly payment on your subordinate financing is, I think, key to making the numbers work and key to attracting new buyers. 0% interest. This doesn't make sense to accrue interest in this kind of a market, in these kinds of neighborhoods where we're trying to restabilize property values, and definitely don't accrue interest on a deferred payment loan. You want to defer any payment. If you are going to require a payment, at least defer it for the first 5 or 10 years till they get on their feet. And frankly, I think no payment at all for the entire term. In weak markets, you might consider that forgiveness of the deferred loan. The fact that you're trying to encourage borrowers to come into a market not knowing whether that neighborhood is going to turn around, whether that property is going to accrue value. It's a wonderful selling point to say that it will be incrementally forgiven over an extended period of time. You want to make sure you avoid windfall gain. Don't let it forgive too quickly. But I think this is a good marketing effort and frankly, a good way to increase demand. We're going to talk more about this stuff next Tuesday in terms of what some of the particulars look like and how that structure is actually undertaken and how the GSEs and lenders look at it. So last sort of point I wanted to make before turning it back to Rob. My voice can be tolerated for only a maximum of about 8 slides in a row. This is sort of the preview of coming attractions. By now we've probably annoyed a couple of you, probably more than a couple, by talking about next Tuesday's session. Because there are a lot of details that can go into some of these discussions, and we will peel the onion, if you will, on detail on some of these things. This is a case in point. We heard in a lot of the roundtables that there is only one market, and that's FHA, and that there's no conventional marketplace. You just heard Matt Callahan say a few minutes ago that he's done a split here. He's done both. He's done Fannie, Freddie, and he's done FHA. And it really depends on the circumstances which is the best vehicle. There have been a lot of changes here, changes on the conventional side that we'll need to talk about, like this increase in the G fee, the guarantee fee, the secondary market players charge that's going to go to pay the payroll tax. It's only 10 basis points, but it's going to impact. We've heard that on FHA that they're raising the mortgage insurance premiums. We've heard on the conventional that the mortgage interest deductibility is going away. It has gone away. January 1st, as of January 1st, you no longer can deduct your MI. So there's some big factors here that are changing the landscape. But generally speaking, we can say that the right path will be determined by these 6 factors. The loan to value. If it's a very high LTV, FHA may be the better option. Borrower contribution. How much of the equity is coming from the borrower versus other sources. The nature of your market. Property values generally. Lender preferences. Some lenders don't do a lot of FHA. Others do a lot of FHA. It really depends on their preferences as well. Some will steer you towards would encourage you to do more of a purchase rehab execution. Others, and there's a lot of fees associated with that. Others will want to keep it simple. So lender preferences need to be understood there. And even what they're going to do with the loan. Are you selling it in the secondary market? Are you going to hold this loan? Is this FHA? Asking those questions are important. And of course, then the soft second structure will influence the type of execution, FHA or conventional. And as we said earlier, whether rehab is part of it. 203K, Rob mentioned, is, it's a mixed bag. And if you're using the streamlined version of 203K, it can be a rather painless exercise, actually, particularly for the direct-to-home buyer program that Rob was talking about earlier. So let me stop there, and Rob, before I turn it back to you, there was one question here that came up on the screen from Michael Glasso that I wanted to try to answer. What's the best way to market the availability of the various financing programs that are available to help potential NSP buyers? Most realtors are unaware of the availability of programs that could help potential buyers. Actually, Rob, this sounds like a good segue to your session.
Before you move on, there's two questions that actually popped in, and I don't know if you can see them, but Linda asked, what is GFE?
What is GFE?
Uh-huh.
Where was that? I'm wondering
Probably
if it was my typo and I meant GSE.
Yeah, G is in go, S is in Sam, E is in O.
Okay. Thank you. Good question, Linda. GSE is a term of art, and I apologize for using it. It really refers to Fannie Mae, Freddie Mac, and the Federal Home Loan Banks. It actually stands for Government-Supported Enterprise. But sorry for being an acronym freak there on you. And are there others?
Let's see. One more. Mortgage interest or mortgage insurance. Question is, deduction going away January 1st?
Yeah, Pat. Patricia, the answer there, I was referring to mortgage insurance. Back in 2006, Congress passed a law that said that not only is mortgage interest deductible, but the insurance you pay. So think of PITI, principal, interest, taxes, insurance. Both the interest, the first I, and the second I, insurance, were deductible up until January 1st. Now, we still retain the mortgage interest deduction. That's as close to apple pie as we get, although it is being discussed. But that still exists. Mortgage insurance deductibility has gone away. Any others? If not, now you get the velvet voice of Rob.
I've never heard that given my Chicago accent. Right. We're moving into property appraisals, and I'm not sure, but for maybe a few other industries in this country, there's just ones like appraisals and property appraisers in which the potential for shenanigans has existed not just in our lifetime, but for a long, long time. And that's because if you look at the second bullet, NSP homes too frequently do not appraise for true value. The phrase true value has absolutely no meaning. Because, as you know, the value of a house is not based at all on how much it costs to build it. It's not based at all on what anyone thinks. It's based on what someone will pay. And so appraisers are trying to do their best to determine how much will someone pay for this. Now, as in the cycle of real estate, for all sorts of good and bad, and we won't go through a lot of that. In fact, we'll go through none of it, only the recent cycle. When making mortgages becomes incredibly lucrative, the potential for appraisers to become part of the problem heightens quite a bit. So what we had during this bubble were a lot of appraisers, and when I say a lot, I'm not talking about the majority, and the bad appraisers made the good appraisers look bad. But we had appraisers who decided it was better to make a loan happen by being as liberal on their valuation as possible to make sure that the loan could happen. And as a result, when everything came crashing down, we had rules put in place and things done and scares put into appraisers where now we heard throughout the roundtables, we can't get a fair appraisal on anything. No one can qualify for a mortgage, not because of their credit, but because the purchase price, the appraisal comes in way below the purchase price, and then they can't get the loan because the purchase price is too high. So what does that all mean? We have some bullets here on this first slide that, appraisers are often poorly informed on the neighborhood stabilization programs. They rely on comps that are not comparable. Those two bullet points are correct. Yes, there are appraisers that look at particular neighborhoods as a whole, whether it's a neighborhood stabilization program neighborhood, an NSP-eligible neighborhood, or just a distressed neighborhood, and define their workspace within their head as based on the neighborhood and see every house within that neighborhood through the same lens. Then you also have appraisers, and they have to rely on comps, but to what extent are they really looking at comparable properties? As you know, the history of REO sales, so properties that are foreclosed on and then sold, the servicer is required and, in fact, limited to simply doing cosmetic repairs and making sure that the home meets code. They do not do energy efficiency rehabs. They do not do anything that makes the home more costly in terms of rehab than is minimally necessary by both cosmetics on the outside and code on the inside. Cosmetics on the inside, too, because you want somebody to walk in and not drop dead because all the walls are open. So what you have is appraisals being asked to compare the sales price of a home that just sold as a distressed REO sale a half a block away, in which it was simply painted and put back on the market, versus your home, which you put a lot of loving care into and a lot of rehab and a lot of thought around energy efficiency, and maybe you've even developed a wastewater usage process for the roof to drain into something where you then recycle the gray water systems to flush the toilets. They don't see the difference. They don't understand that. They just see one house sold down the block with 3 bedrooms and 1 bath, and this is a house with 3 bedrooms and 1 bath, and it's selling as a distressed sale because it was a formerly foreclosed on house, and so it's got to be the same price. That's something we're going to talk in a little bit. Can you go back 1 second, Tasha? I'm sorry. That will be something we'll talk in a little bit because that's an education opportunity. We've learned in this work over the last 10 years that every horrible thing that happens provides us with an opportunity to educate. Problem is, half the time no one listens to us. So the last bullet point is the one I really want you to take away from this slide. Just because the regulations prohibit the lenders from now having direct communications with the appraisers they are retaining to look at the property, nothing prohibits you from having those conversations. You as the seller, you as the NSP grantee, you as the entity in your community that's concerned about making sure the properties, you get properties to appraise for what you think their real value is based on the amount of work that's gone into it. Nothing prevents you from talking to the appraiser. The lender can't, you can. Okay, Tasha, thanks. So what does that mean? You can have actually separate conversations with the lenders and the appraisers in your community to talk about how this process is working. You can even go to the associations of the appraisers in your community and bring them together with lenders in a roundtable discussion, as long as it's not on a particular property, and talk about how this is all working to try to increase the sense of everyone that they're in this together, that you all have a common mission of selling these properties for their true value, not an inflated value, not a false value, but for the amount of work you've put into it, and your goal is to stabilize the property values in that community. The next bullet would be great. It may be very difficult, but to get some sort of NSP program-wide approval of how the lenders, the financing entities like the GSEs or the state HFAs approach appraisers. Whether that's a pipe dream or not, I'll leave it to you starry-eyed dreamers to go down that road. But again, this is all about inserting yourself as an NSP grantee or a sub-grantee who is a developer trying to sell houses into this process without violating the new rules. So I think that's it came out in these roundtable discussions that many thought those rules prohibited them from talking to appraisers, or they didn't know why the lenders weren't talking to the appraisers, and then it just sat and were mad about that. So the other piece of this that we talked about on the last slide was you are, especially under NSP 2 and 3, required to do green rehab. Well, what does that mean? That's a whole other discussion. But it does clearly improve the value of that property. If Energy Star is your standard for appliances, if insulation at R60 or R90 is your standard in the attic, if everything you do, the wrapping, the outside of the property, and everything you do inside the property is geared towards energy efficiency, you've reduced the cost of owning that home, which should increase its value. But most appraisers don't focus on that. It's your obligation, responsibility, or your opportunity to talk to your appraisers about the kind of standards you're using on your homes. That this is something that should be given credit and given weight in terms of the valuation. We're going to hear from Kim Stans from Columbus in a little bit about how do you educate this in a broader sense? How do you put out materials in your community for appraisers to look at, to even keep in their back pocket, little cheat sheets about, hey, when you're looking at homes to appraise them, these are the types of things we're putting in. If you're looking at homes that we haven't worked on, start to contrast and compare what that looks like so your appraisers can be a little more precise in terms of comparing an NSP rehabbed home and a servicer rehabbed home. So maybe we can see a distinction in the prices in terms of your appraisal amount. Anything that you give to a professional that helps them do their job better is usually almost always appreciated. Occasionally you get somebody who says, I know my job and don't tell me how to do it. But for the most part, what we heard from appraisers who attended some of these roundtables is they appreciate any information that you add to their understanding of a neighborhood. Next one, please, Tasha. Okay, so go so far as to hold a training session. Invite, get your state appraisal association to identify those people in your community that you want to invite to a training session around what your property rehab standards are, how you're going about trying to fix a neighborhood. Again, they see the neighborhood as something through their eyes. Try to get them to see the neighborhood through your eyes. What other city resources are going into that neighborhood? What other investment is going into that neighborhood that they don't know about or can't see? Get them to view the world through your lenses. The next one is sort of everybody's nirvana, which is buying all the vacant properties on a couple blocks so you can control everything in terms of property rehab standards for the entire 2 or 3 block area. Then you have comps that everyone can, compare apples to apples. Again, it's a lot harder than that bullet point makes it sound. It sounds like a great thing. If you can do it, obviously that's great. But that is the difficult piece of that is that those properties are all owned by different investors and different servicers, and which makes it more difficult. But that's where the National Community Stabilization Trust comes in, but that's enough about that commercial. Go so far as to go to your state licensing board and see if they'll do some in their continuing education for appraisers. Will they hold a session on NSP standards and rehab and what valuations might look like for NSP properties? These are all people who want to keep their profession at the top of its game, and helping them understand the nuances of this program, of your rehab standards, of the way you view your neighborhood becomes a very important arrow in your quiver in terms of trying to build this capacity to stabilize neighborhoods. Creating special designation and certification for people who you could call NSP appraisers, again, that's something that only it becomes false unless you really get some recognition from your state licensing boards or your local association. If the local association says, yeah, we'll be glad to work with you to create some sort of designation for those folks that go through this training that you're helping us put together, it can be a little certificate or it can be a gold medal or whatever. That becomes something that the industry has to help you with in terms of that special designation. But it could be very good in terms of people then, all professionals want as many medals as they can have, so they'll want to get certified or at least designated as an NSP appraiser. Next, Tasha. Now we're talking about realtors as opposed to appraisers. This is a pretty simple thing for all of you. You've all done this. I'm sure you've all reached out to your realtors, either in your home buyer directed programs where you say to realtors, have your borrowers come to us and buy one of our NSP eligible homes. But how you do that even further in terms of talking about your plans for a particular neighborhood, real estate professionals, realtors are as interested in the marketing of a neighborhood that they're working in as you are. They only exist to make money. Well, that sounds a little harsh, but that's their role. They want to sell properties to make money, and they only sell properties if there's people that want to live there. And the people only want to live there if they think it's a decent place to live. So marketing your neighborhoods, marketing your communities where you're working with your fellow professionals, the realtors in the world, becomes very, very important. They also know how to do it probably better than a lot of us do, coming out of the nonprofit multifamily housing development arena, and they probably know how to do it better than a lot of the home buyer counseling groups. that's their job. They're supposed to put the best spin. They're the ones that always come up with the cute names for the particular neighborhoods and hopefully get little things hanging on the light poles. And they're really good. And if you can get them to work with you to talk about how to market that neighborhood you're working on, you're going to be that much farther along in trying to find interested buyers. We've found the biggest issue is this. This is a huge overstatement, but where someone has a choice, if you are in today's world, it's hard enough to get eligible to get a mortgage. If you can get a mortgage, you have a lot of choices just because of the nature of the vacancy problems that all communities have. So you're not going to choose a neighborhood in which somebody says, oh, this is, I swear it's up and coming. There's no evidence of that, but they're just not. They're going to go somewhere that they already know is stable. But if you can work with your real estate professionals to talk about your neighborhood as stable and up and coming, or stable and, for families, or however you want to do that, you're going to be in much better shape getting those people who are eligible for mortgages today to move into your NSP homes. Before I go to the key takeaways, coming out of the Chicago, you can have the slide up there, Tasha, that's fine. Coming out of the Chicago Roundtable, Kim Stans from Columbus decided he needed to have the same conversation with his folks in Columbus. He needed to bring them together to talk about that and have some real outcomes that were specific to Columbus. So, Kim, if they have unmuted you, so you may now speak and be heard, if you could talk about your experience for a couple minutes.
Hi, thanks, Rob. Columbus and Franklin County have NSP 1, 2, and 3 funds. And so I went to Chicago, which was the first roundtable, I believe, and was very impressed with, as I watched the dialogue between lenders and NSP grantees, the things that were surfaced there as they started to work towards solutions. And so, as Rob said, I wanted to bring that to Columbus. And so I went to Craig and to Rob, and they went back to HUD and to Enterprise and said yes, they'd be willing to do that. And what I wanted to do is focus specifically on Columbus and Franklin County and not make it a regional thing, but really focus in our market areas. And so just like all of you on the line, probably our goal is to build and sell quality, affordable, green housing to qualified buyers. And so we knew we needed to have some answers in order to sell that housing. And so as they came into Columbus, one of the things I wanted to do is expand the circle a little bit to include not just lenders and grantees and the developers that we work with, but also to include the real estate professionals, the appraisers, the homebuyer counselors, so that all of us could break through those silos and begin to talk to each other, work towards building solutions to the challenges we had. So we had a facilitated discussion one afternoon back in October. Had about 36 folks from those different industries who came together. And out of that, saw a lot of the things that you're seeing here, that we had a lot of those challenges. One of those big ones was around education of each of those sectors. And so we not only started to open those doors to each other, but started to see there's things we could do in the future. So in the next couple months, we're going to be bringing together a larger group to really educate people around NSP, so that lenders can talk about their products, so that the real estate professionals can talk about what they are doing, so that we can really begin to market NSP housing throughout the city that we're working with.
Great. Kim, could you just quickly comment on the receptivity of the lenders and the appraisers that were in the room and the real estate agents in terms of wanting to partner with you?
Yeah, there was a great receptivity because people, as Rob said earlier, people want to be involved. I mean, they want to sell houses, or they want to have loan products that are, being put out into the market. Just today, I was in a meeting that kind of illustrated this. we were sitting in a house. I was in a board meeting in a house that's newly built, funded with NSP, getting ready to be sold to a home buyer, and the nonprofit CDC had worked with an appraiser to begin to help them understand what the house was in terms of its green build, but also in the comps, the appraiser, as they worked with the nonprofit, began to look at other NSP units in other neighborhoods versus just the immediate distressed neighborhood that was around this house. And so that was one example. The other example is the lender who was in the room said, I think it's time that we bring lenders together because we are seeing that the portfolio products are starting to take hold and other products are starting to come out, and it's a good time in this next couple quarters to bring lenders together to start talking about their products and present that to others. So there's real a groundswell, I think, happening because we're talking with each other.
Great, thanks.
Hey, Rob?
Yes.
Can I just interject one thing about the real estate professional? Kind of feeds off of what Kim was saying, but the National Association of Realtors has been talking to the industry and certainly to us quite a bit about how do they get their realtors more involved. And they're very focused on getting state boards and local realtor associations to be more cognizant of NSP and how the realtor can play a big role. The big sort of sea change that we're beginning to see is, realtors used to say 2 years ago, oh, we don't want a part of some federal program. There's too many bells and whistles and requirements and restrictions. We're better off without it. And once we and others were able to explain that this is not a cumbersome program, and really what we're talking about is, do you want to sell fully renovated properties that used to be abandoned, fully renovated properties that require someone to represent the seller and a prospective buyer? They went, well, heck yes. So I think, the learning curve for some segments of our industry have been a little bit slower, but I feel like we're heading into a new stage of this effort where we've got more informed industry partners, I hope.
That's true. So if we look at slide 30, the first bullet, Craig just indicated, is a bit stale in the sense that, yes, the real estate agents especially used to want to steer clear of federal programs because it took too long. There was an uncertainty as to closing, and they make money as they close homes, either as the seller's agent or the buyer's agent, and the longer it takes as a result of restrictions or regulations, the less they ultimately make in terms of time equals money. But that's changing for a couple reasons. One, there's not enough deals out there, and they need to sell houses, and so they're willing to stretch their prior restrictive approaches to what sales they would get involved in. And two, they're coming to conclude that this particular one, at least NSP, is no different than the traditional homeowner assistance programs that have been out there as it's approached. And if it's not the homeowner assistance, if it's not down payment assistance, it's simply a nonprofit selling the property as opposed to an owner-occupant. And what they're being sold is a very nice house with lots of beneficial rehabilitation standards built in. So we have seen a change in that. The rest of those bullets are pretty self-evident. I think Kim's message to everyone on the phone is simply look to your partners that maybe were not your traditional partners and get them engaged in a way that it becomes part of their professional life, meaning learning about the neighborhoods you're working in, learning about the rehab standards you use, learning about the NSP program so that it is an additional educational tool for them in their professional life and makes them want to be more part of what you're doing. So with it,
Rob, this is John.
Yes.
I was just wondering, it seems to me that a lot of times people think, well, geez, I got to go out and convince every appraiser or every lender in my community. And, in reality, am I wrong in thinking that you really just need to get, 4 or 5 good ones that you can work with on a regular basis, and get a little bit of competition there? I think people make the mountain even higher than it might be in some cases. Is that your experience, or maybe Kim knows?
Yeah. In fact, there was one of the bullets on one of those slides was about some sort of priority list of actually the bullet on the takeaways on 30, the bottom one, create a list of those that have done a few deals, so they know how you work and how the whole thing is. And yeah, it's not everybody, but the good thing about using the associations to start is it gives it the legitimacy of saying to all the ones that are out there, this is something as an industry you should at least think about. Now, out of that will come, not everyone's going to want to play in this space, but out of that will come the 4 or 5 or 2 or 3 even that you need, and that may be all you need. Same is true on the appraiser side. So you're using the associations to get the word out generally, but the work is going to be with smaller numbers in more detail. Just as Kim was saying, in that house that had just been renovated, that work was going on with there was a particular lender and a particular appraiser, and that's how it'll go forward. So yeah, you don't have to wait until you've convinced every single real estate agent and every single appraiser in your community, but you want to, by using the associations to be able to speak to all of them at least once, you have that legitimacy bestowed upon you that the association is saying, this is something we think our professionals within our profession should know about and should understand. So I'm going to turn it back to Craig for conclusion.
We had another question come in, if you don't mind.
No.
The question was, someone had an underwriter tell them that the FHA will no longer allow soft second to cover funds needed for a down payment, and whether that was true.
If it is true, we have a major problem. I don't think that's true. I'd like to ask Matt Callahan if he's heard anything like that in his originations. But no, I mean, FHA has been pretty easy to work with after we approve the provider of the soft second. As Matt Callahan said, sometimes that's the stumbling block. But clearly soft seconds are being encouraged. And without making this sound like an infomercial for FHA these days, I think the new a lot of changes at FHA recently, but the leadership in FHA, Carol Galante, the acting FHA commissioner, there's a new single-family deputy assistant secretary, Charles Coulter, and others are very supportive of NSP. John and the CPD folks should speak to this too, but seem very supportive. Many of you may know we just got an extension of the anti-flip provision, a waiver that allows NSP to not apply to that 90-day turnover of a property rule. So we're seeing nothing but cooperation there. But Matt, is there something on the ground that we're not aware of?
Craig, this is John. There is a little thing that applies just to the seller providing down payment assistance. And so it doesn't screw up most soft seconds, but there is a provision that was written into the Housing and Economic Recovery Act that has nothing to do with NSP per se, and it was written in response to a problem situation in one jurisdiction. But it was there were problems between the sellers of assisted housing and the buyers getting sort of a little bit too favorable consideration on down payment assistance or whatever. So without going into gory details, there is a policy alert that we put out about March of 2010, I think it was, about this issue and how to work around it. If you absolutely have to put down payment assistance into a unit, basically you end up needing to use another entity, transfer the title to a nonprofit, and then have the city or county or whoever provide the down payment assistance. In many cases, that number is not big enough to go through that hassle for. On the other hand, down payment money is different than debt, and so it's often a critical number for people. So there is a glitch. It has affected a few people just with FHA. We have not heard a lot of problems about it recently, but there is a little barrier there.
Greg, this is Matt. I was just going to add, while I was on this webinar today, we actually closed an FHA loan involving public agency-provided down payment assistance where the borrower contributed 1% of the purchase price and the balance of the 3.5% down payment came from the public agency assistance. So whenever you have an approved soft second program issued by an approved source such as a governmental entity, those funds can be treated as if they were borrower funds for the down payment, up to all of the required down payment. Typically, most jurisdictions are requiring some minimum level, like 1% from the borrower, but beyond that, the balance of the funds needed for the down payment can come from the public agency second mortgage.
Okay, good. Well, let's sum up here then on where we are. If we go to the next slide here with some of our concluding comments, I think this is all self-evident at this point, and many of it I think you would hopefully agree with, but mortgage underwriting, there's no question that it has become tougher. Hello? Oh. There's no question that obtaining a mortgage has become more difficult. And we know that many of the borrowers who are seeking mortgage financing in these neighborhoods may be those that are formerly from that neighborhood, may have some credit challenges, may be first-time home buyers, and that just adds to the struggle. But we'd like to think of it more as a return to the basics. For as much as there is a more conservative underwriting regime out there, I think we have a very strong case to build here. And let's not forget, something we probably should have said, I should have said at the very beginning, we have a lot going for us, too. We've got interest rates that are historically at a low that we haven't seen in decades. We have housing prices that are more affordable. And we have a number of tools here that, have not always been available to us to fund our soft seconds and other structures. So it's tough but eminently doable. Secondly, that high LTV lending, high loan-to-value lending is still possible. The GSEs, despite what you hear, are making available Home Possible from Freddie Mac, My Community Mortgage at Fannie Mae, and we're seeing an uptick in the volume in those two programs of late, and FHA has, without question, been a mainstay here over the last couple of years. But this is especially the case if there's borrower skin in the game, even if it's that 1% that Matt just mentioned, that we have true soft seconds, not hard-to-edge seconds, and we have borrowers who are ready. And, of course, with the NSP requirements around home buyer education, that's certainly the case, too. Direct-to-home buyer programs are going to be an important element, and we see a growing interest in some of those direct-to-home buyer programs for properties in good condition. But we still think probably the easiest mortgage to obtain is on the fully renovated property that previously was abandoned, now has been fixed up with your assistance, and is being made available as a billboard within the neighborhood of hope. Soft second program designs, keep them simple. The simpler the better, because you'll just get more lender participation and more universal liquidity from the GSEs or FHA. And then lastly, to Rob's points about building partnerships with appraisers and real estate professionals and everybody else, I feel like we're in the second generation of neighborhood stabilization in 2012, and a big hallmark of that is that it won't be just this merry band of NSP grantees and subrecipients and a few others that are engaged, but there'll be a growing awareness that this is a trend, that's something that everybody should be jumping on board to be part of. And just like Kim stands, we would encourage all of you to reknit not just the neighborhood, but the industry partnerships that have been frayed for the last few years. Okay, just a preview of coming attractions for what's around the corner, and then we'll answer any other questions you might have. Next Tuesday, I think it's Tuesday, yep, we'll have part 2 of this, a deeper dive on mortgage financing. If you feel you got from this one what you need, no need to come back. But if Rob's velvet voice is drawing you back on Tuesday, we'll talk a little bit more about the details of FHA, when that makes sense, when conventional makes sense, a little bit more about the soft second structures, and answer some more of your questions. And then the interim financing discussion, it says here January 31st. Please make note, it's February 2nd. We had to change the date. And so February 2nd, there'll be a discussion on how to leverage your NSP dollars so that you can get some private capital deployed for acquisition and renovation of properties. We need to have that happen. Program income is going to be important, but it just can't do everything, as you well know. And I think now we have enough proof points that we can get the capital markets back into the game. So that's it, other than some source information at the end. Yes?
There was someone that had written in that they missed the answer to the question about the FHA allowing the soft second to cover funds needed for down payment. Can you go over that answer one more time?
Well, I can try, but John Lastwick may have to bail me out on his inside intel from what he said. But generally speaking, there is no prohibition on soft seconds per se. There was an isolated incident, one or two going back a year or so, that have been dealt with, and maybe there's been too broad an interpretation by some underwriters, but certainly FHA is open for business with soft second activity, generally speaking. John, did I say that fairly?
It sounds like it's a little better than what I was led to believe the situation is. So, but I mean, I think the bottom line is there's ways to do it. There are no barriers to soft seconds and other sorts of favorable financing, as Craig said. The only little piece is you can pay up to half of someone's down payment, and there may be an issue with who's making the payment, and so you just want to be careful on that one. But maybe they're kind of loosening up on that one too.
Well, I think that's a really good point. I mean, as Matt Callahan said too, the FHA is much more controlling or involved, if you will. Controlling is probably not the right word. Involved in ascertaining who the provider of the soft second is. That's a very important element with FHA.
There's one more question. For NSP3 with option 1, direct to home buyer, can NSP cover 100% of borrower's minimum investment? For FHA, that would be the 3.5% required down payment.
Well, there's a restriction on that comes from the CDBG program on down payment assistance, and you are limited to half of the down payment coming from NSP. So, as Craig or Rob mentioned, most lenders or most programs require some sort of a minimum buyer investment anyway. And if you're going the FHA route, is 3.5% down, so you've got 1.75% you can pay. Then, if the family can't afford the other 1.75%, you may have to find another source of funds for a piece of that. But that's the only real restriction, and it's generally such a small number that it's not impossible to figure it out. But it's a big number if you're the buyer, and that 3.5% is a lot of money to you. So, and it's not something you could typically bury as debt. I guess if you could figure out a way to consider it debt, which is what I got from what Matt was saying, then maybe that's the way to thread that needle.
And just keep in mind to feed off of John's comment, the difference here between FHA rules and NSP rules. John's referring to a provision that is applicable to NSP. FHA would actually allow the full down payment to be from other sources, but if you're using NSP, because it works off of a CDBG infrastructure, half of that down payment would have to come from the borrower.
Or another source.
Or another source.
This can't come from NSP.
Yeah.
If there's another comment and a question, I think if NSP provides 20% down, FHA does not care. It is only the higher LTV that they are worried about, ?
Well, I think we need to refer back to the policy guidance that we put out about a year and a half ago I don't have it in front of me, so I'm a little reluctant to start making too many statements. But it really is a limited set of circumstances in which it applies.
Yeah, Craig, this is Matt. The real distinction comes down as to who the provider of the soft second is, and I think in those situations where there's been a problem, it's because it's been found that the provider is somehow an interested party, such as a builder, and so those are not permitted situations, even if the soft second structure would otherwise qualify. So where the soft second is provided by an approved entity, there's never a problem applying that as the borrower's down payment, and there isn't an LTV issue. In other words, you don't need to have 20% down coming from the public agency to make this more palatable. That's not the issue.
Yeah, it's a very specific law that was written in response to a very, sort of limited set of circumstances. And Matt's correct that it's just, when the seller is in effect also providing the down payment assistance that FHA perceives by law that, there could be a conflict of interest there. So basically the way to solve that is to split the seller and the provider of the soft second. And if you're going to have a lot of those, there's probably a way to structure some kind of an arrangement where you can get that done. I've not really heard a lot of problems about it lately.
Okay.
I don't have anything else.
Okay.
So if anybody has any last-minute questions.
Do we not have any call-in questions? Or does everything have to be written?
No, they can just raise their hand and we can unmute them, but all the questions so far have been submitted through Q&A.
I'm not 100% sure we discussed how you'd go about doing that, so. Could we just explain? I'm not sure how to do it.
Sure.
Jesus has a question, and you are now unmuted. You can ask your question.
Hi, this is Jesus Morales in the city of Corona, Southern California. In regards to the soft seconds, do the GSEs have any issues if you have an equity share provision in the loan documents, and when they resell the home, they make a profit, we're going to split that profit?
Yeah, that's a great question, Jesus, and the answer is yes, they have concerns around equity share. They don't have a hard and fast prohibition on it, but they want to understand the circumstances behind an equity share or anything that might be construed as usurping equity. Matt, this is a common question we get not only in Corona but other parts of California. Have you run into a discussion or an issue with the shared equity approach with the GSEs?
Yeah, basically shared equity provisions are fine, and the typical guidance you get is that the equity share proportion should be based on it should be equivalent to the amount of the public agency's initial investment of the purchase. So if the public agency initial investment towards the purchase represents, let's say, 20% of the purchase price, the equity share portion the equity share on the back end when the home is finally sold shouldn't exceed 20%. When it goes beyond that, then you're really taking away from the home buyer's incentive for long-term ownership of the property, and what a home buyer would normally expect to get, which is the natural appreciation of the home over time, plus any pay down of the mortgage as a amortizer loan. So as long as the equity share is proportional to the initial investment, it's acceptable and it's considered fair, by consumers.
And by HUD rules, it should be proportional if you look at the home program instructions on that. So, and there's also a distinction to be made between appreciation and really sharing the equity that somebody already has or that you've already put into the home, and the appreciation above and beyond 100% of today's current market value. And the reason that's important, I think, is that there are situations in which your appraisers are not going to get you the number that you need, and you end up having to basically make a development subsidy, a deeper subsidy than you really feel is appropriate. And in those situations, you may need to do that to jumpstart the market, and you may need to make a few of those to get things going. But that's a good situation to consider, that shared appreciation, to say, well, we're going to sell you this house for $100,000, but if in 2 years it's worth $150,000, then some of that's ours. And I think that's a legitimate tool to be thinking about for these sort of more difficult neighborhoods that you're working in.
It's a heck of a sight better than accruing interest when you don't know if, in fact, there will be an accrual in value. So the nice thing about a shared equity is you only share in something that's up, and if it doesn't exist, if there's no increase in value and therefore no improvement in equity, then your 20% share of nothing is nothing. It's a much fairer execution.
There was a question that also came through from Jim Steck. His question was, how long is the FHA approval process?
I guess the short, glib answer is it depends. But I think, part of it depends is, are you talking about approval of the soft second provider or of an individual loan application? Because on a loan application, and Matt, again, would like to hear the firsthand observation, but there's a little bit more work to be done, but it doesn't take that much longer, does it?
No, it doesn't. And if you're talking about getting a soft second program approved for use of FHA loans, that's 100% driven by the lender who's going to originate the loan. And we've gotten them approved in a matter of a few days, and I've seen some situations, especially, unfortunately, with the larger institutions, it can take months. So, your best bet, I think, is to shop your program around as many lenders as possible and ask them up front, how long is it going to take to approve this for use with FHA loans? And having all the relevant documents ready and in the name and the issuer of the loan and all their legal structure is going to speed that up. But it doesn't have to take long time.
Ebony Baylor has a question. Ebony, you're now unmuted. You can ask your question.
Thank you, everybody. Thanks for this webinar. It's been very informative. I have a question regarding lenders and the minimum amount financed. I'm not sure if any of the other grantees are experiencing any trouble, but we're trying to figure out the best way to get home buyers financed to meet that 25%. We're not finding that, the home buyers are, I guess, they can't afford a whole lot of house. And we're finding that the lenders are having a minimum amount that they're willing to finance that is not quite low enough to extend a mortgage to someone that might fit the 25% set aside. So I was wondering if there are any resources or any other strategies that you guys can share that may be able to assist in that.
Greg, this is Matt again. I think in those situations where you have a very low balance first mortgage, it is going to be very challenging. The economics of making such a loan are tough. So I think in those situations, you may almost have to look to like a CDFI or some other, financial institution that has a public purpose mission that might originate those loans, maybe in the future for ultimate resale, but it's going to be very, very tough for small, low-balance loans to be originated. Not impossible, but tough.
Yeah, Rob, I wonder if you want to comment, because I know in the Chicago session, in particular, this came up with a lot of low-value markets in the Midwest there. And a number of the larger lenders readily admitted that this is an issue for them that they needed to solve for. Any thoughts on your part?
They haven't solved for it yet. I think the single thing to keep in mind is there are probably either locally but more likely regionally some, as Matt said, some CDFI loan fund that can do the $20,000, $30,000 type mortgages or $40,000. But no, we heard this out of Iowa, out of Michigan. It is a problem when it's just not an economical thing for a large institution to do. You got to look at your local banks, very local, 2 branches or 3 branches, or CDFI funds.
I would agree with that, and I think the local lenders, the community banks, are a good source for this. I think some of the new portfolio products may be good for this too, because they want to do loans in neighborhood stabilization markets, as opposed to they want to make just a lot of money. The biggest problem here, just maybe this is stating the obvious, is that people the loan originators get paid on the basis of a percentage of the size of the deal, and when the deal is tiny, the work is just as significant. It's just that the proceeds, the quote unquote profit to the institution, is less. We have got to make sure with the large institutions that they are getting back to the days when they have specific identified personnel that are dedicated to community development activity, and that part of that is maybe a compensation structure. I know a number of them are talking about this, a compensation structure that works differently for low-value properties, where they get paid for doing the deal rather than as a percentage of the outstanding mortgage balance.
What about credit unions, Craig? Have you seen any activity there?
We have. I think that's a good option for the future, John. I think in a lot of cases credit unions were not up to speed on the program initially unless one of the local grantees went in and got them up to speed. But I think there's certainly a good example of where there's a collaborative, cooperative willingness to try to do smaller loans. It will vary around the country, of course. Any others?
Let me check the queue once more. There is. Jeff Holmes had a question. Instead of using the verbiage down payment, how about the verbiage gap? Will this allow minimum allowed or max LTVs on that particular loan program, i.e. RHA?
FHA.
I'm sorry, FHA.
I don't think so, but I think there's ways around it, but I don't think there's semantic ways around it.
Yeah, I would agree with that.
And our queues are empty both ways.
Yeah, I think just one last thought there on the down payment. Sometimes we use, it's a good point, because sometimes we use down payment, but it's much more than a down payment, right? It's maybe 5% of the 15% you're contributing is to meet a down payment requirement. The other 10% is to lower the monthly carrying costs so the mortgage is more affordable. We sometimes refer to the whole thing as down payment, and it may not change the FHA issue that we were discussing, but the truth is sometimes we maybe should differentiate that which is going towards the down payment as opposed to that which is reducing the monthly carrying cost.
Well, we thank everyone for attending. Actually, the materials, I believe, are already on the Resource Exchange, so they can find the materials already there. And I know that a transcript and recording will be sent to ICF in the next week, I believe.
Great.
Okay, thank you.
Thank you all.